Have you ever, walked down a street in a major city, maybe looked up at a massive, gleaming downtown skyscraper and thought, you know, I wish I could collect the rent on this place?
Oh, I think we've all been there.
Right.
Yeah.
Or maybe you were just walking through a really packed shopping mall and you started running the math in your head on what those retail leases must cost.
It's a huge number.
Exactly. But then, reality sets in. You realize you don't exactly have hundreds of millions of dollars just lying around to spare, let alone the entire infrastructure you'd need to manage a property of that size.
Yeah, it's a very common daydream. I mean, commercial real estate has always carried this sort of aura of being an exclusive club.
Right, with a massive bouncer at the door.
Exactly, an impossibly high barrier to entry. For a long time, if you didn't have immense institutional capital, you were simply locked out of that level of wealth generation.
Well, that is exactly what we are getting into today. We are pulling from a really comprehensive set of sources on the structure, operations, and investment strategies of real estate investment trusts, which, by the way, are pronounced treats. Just kidding, they're pronounced REITs.
Yeah, REITs.
So the mission of this deep dive is to basically decode how this specific vehicle offers a shortcut to real estate ownership. Because you get to skip the headaches of being a landlord, avoiding those 3 a.m. phone calls about a leaky roof.
Nobody wants those.
Definitely not. And most importantly, you don't need a billion-dollar trust fund to get started.
Right, because direct real estate ownership, I mean, obviously it requires capital, but it also requires an immense amount of time, legal maneuvering, operational expertise, and REITs just abstract that entirely away for the average investor.
Okay, let's unpack this a bit. Before we dive into the really complex accounting of how these trusts actually make you money, we sort of need to look at why the government even allowed this structure to exist in the first place.
Yeah, the history here is actually pretty wild.
Because it wasn't always an option. If you go way back to the 1880s, trusts actually enjoyed a tax-advantaged status. But then in the 1930s, the government abruptly reversed course.
Right. They started taxing passive investments at the corporate level.
And the real estate industry was not happy about that.
Oh, they were furious. I mean, they spent 30 years aggressively lobbying to get that overturned because they were stuck watching all these other industries innovate while commercial real estate was just completely paralyzed by this tax structure.
Capital was totally bottlenecked.
Exactly. But finally, the breaking point arrived in 1960. There was this massive nationwide demand for real estate funds to fuel new development. So President Eisenhower actually signed a tax provision that allowed REITs to qualify as pass-through entities.
Okay, so by making them pass-through entities, the government essentially allowed real estate to follow a traditional corporate equity model. It's basically crowdfunding a real estate empire.
That's a great way to look at it.
You buy shares, you own a fractional piece of the portfolio. But, okay, for you, the listener, sitting at home, looking to maybe park your capital somewhere safe.
Yeah.
How does this structure actually alter your financial risk profile compared to, say, just buying a duplex down the street?
Well, that 1960 legislation fundamentally shifted commercial real estate from being a highly illiquid asset into a very liquid, easily sellable equity model for the masses.
Right.
And the risk mitigation, it comes directly from the portfolio scale. Think about it. If you own a duplex and one tenant moves out, you just lost 50% of your revenue.
Yeah, you are in a crisis mode instantly.
Exactly. But if you invest in a REIT that owns, say, 200 apartment buildings spread across 5 different states, and a tenant moves out of one unit.
It's nothing.
Right. It's a statistical rounding error. The geographic and tenant diversification just inherently insulates you from those catastrophic localized failures.
But the government didn't just, hand out this pass-through tax break blindly. I mean, if a corporation is going to entirely bypass federal and state corporate income tax by passing the burden straight to the shareholders, Washington is going to attach some serious strings.
Oh, absolutely. They basically built a mathematical cage to ensure these companies stay exactly in their lane.
Yeah, the rulebook is notoriously rigid in the sources.
Right.
A REIT must be structured as a corporation or a business trust managed by a board with fully transferable shares.
But the ownership rules are where you really see the government's true intent.
Oh, yeah.
A REIT must have at least 100 shareholders, and crucially, no more than 50% of its shares can be held by 5 or fewer individuals during the last half of the taxable year.
Which is so clearly designed to stop, 5 billionaires from just throwing their personal real estate portfolios into a trust to dodge corporate taxes.
Precisely. It forces the ownership to remain democratized.
Right. But then we get into the asset and income tests. And this is the cage I was talking about. A REIT has to hold at least 75% of its total investment assets in pure real
Right.
estate. And on the income side, they have to pass a 75% test and a 95% test. Can you break those down?
Sure. So those tests are the primary guardrails. At least
Yeah.
75% of their gross income has to come directly from real estate sources. So we're talking rents, gains from selling property, or foreclosure income.
Okay. And the 95% test.
The 95% test broadens that just a little bit.
Yeah.
It dictates that 95% of gross income must come from financial investments, which of course includes the rents we just talked about, but it also allows for standard dividends, interest, and capital gains.
Meaning they can park some spare cash in treasury bonds or safe equities and earn a little interest without losing their REIT status.
Exactly.
But they absolutely cannot start operating like a hedge fund or, a tech startup. They are firmly fenced into real estate and passive finance.
Right. They're completely locked in.
But here is the golden rule, the one that really dictates every single move a REIT makes. To qualify, the company must distribute at least 90% of its taxable income to its shareholders every single year.
That's the big one.
And the sources note that most actually just pay out 100%.
Yeah, because they deduct those dividends from their corporate taxable income, which drops their corporate tax liability to essentially zero.
But wait, I really have to push back here.
Okay.
Because think about how a normal business operates, like Apple or Microsoft. They hoard billions of dollars in cash reserves to fund research, build a new headquarters, or just survive a bad recession.
Right.
If a REIT is legally forced to give away almost all of its cash to the shareholders every December, it's like trying to build a global empire when your bank account is forcibly drained to zero. How on earth do they fund new development projects or actually acquire new properties?
And that paradox is the defining characteristic of the entire REIT industry.
It's why.
It really is. Because they cannot rely on internal cash reserves for major expansions, they are perpetually tethered to external capital markets.
Okay.
A standard corporation might issue equity once, at their IPO and then just grow organically for decades using their own profits. A REIT has to constantly go back to the well.
They just have to keep issuing new shares.
Constantly. They rely super heavily on initial public offerings and secondary stock offerings. They issue shares, they take that external capital, and they use it to buy or develop new assets,
Wow.
which makes their growth strategy this constant, delicate balancing act. Management is always having to weigh the need for fresh capital to buy, say, a lucrative new office building against the very real risk of diluting the value of the shares already held by their existing investors.
Because they're always hungry for that outside capital, they've basically had to mutate over the decades. They've evolved into these distinct flavors, I guess, to attract different types of money depending on an investor's appetite for risk and yield.
Yeah, the sources break down three primary types. You have equity, mortgage, and hybrid.
Let's start with equity.
So equity REITs, or E-REITs, are the traditional model. They purchase, own, and manage physical income-producing real estate.
Like actual buildings.
Exactly. Office parks, industrial logistics centers, residential high-rises. And they are not fix-and-flip developers. They acquire properties to operate them, generating yield from steady rental income and occasional capital gains when a property is strategically sold.
Okay, so equity REITs are basically the landlord.
Yes. Now, mortgage REITs, or M-REITs, on the other hand, they do not own the physical buildings.
Wait, they don't own buildings?
No, they provide the financing, they loan money directly to real estate owners, or they purchase existing mortgages and mortgage-backed securities on the secondary market.
Oh, interesting.
Yeah, their revenue model is entirely different. It is driven by the net interest margin, which is just the spread between the interest they earn on those mortgage loans and the cost of the capital they borrowed to fund them.
Okay, so if equity REITs are the landlord, mortgage REITs are the bank.
Precisely.
Which means mortgage REITs must be hypersensitive to interest rate fluctuations. Like, if Jerome Powell and the Federal Reserve suddenly hike interest rates, the cost of borrowing goes up, and a mortgage REIT's profit spread can just get compressed overnight.
Oh, it can vanish completely.
Yeah, the sources actually point out that they are highly speculative vehicles. They're generally favored when investors are explicitly betting on interest rates dropping.
Right. And today there are roughly 40 mortgage REITs operating, kind of split between residential mortgage securities and commercial mortgages.
And then there's a third type, the hybrid REITs.
Right. And naturally, hybrid REITs attempt to straddle both worlds. They own physical property while also holding a portfolio of loans, basically aiming for a blended risk profile.
So those are the underlying assets. But for you, the listener, trying to decide where to deploy your capital, the classification that matters just as much is how you actually purchase the shares.
Yes, the structure of the offering is crucial.
We have publicly traded REITs, private REITs, and then this highly controversial middle ground called non-exchange traded REITs. Let's walk through those.
Well, the publicly traded REITs are straightforward. They are SEC registered, entirely transparent, and they're traded daily on major exchanges like the New York Stock Exchange.
Super easy to access.
Exactly. You can buy or sell your position in seconds. They manage over $400 billion in assets. Now, private REITs operate in the shadows by comparison.
The VIP room.
Pretty much. There are hundreds of them in the U.S., but they are not SEC registered, they don't trade publicly at all, and they only raise equity from accredited high net worth individuals or institutional trusts.
Okay, then you have the non-exchange traded REITs.
Mhm.
These are SEC registered, meaning they do have regulatory oversight, but they do not trade on public exchanges.
Right.
Private sponsors market these really heavily to retail investors who might honestly have a little PTSD from the volatility of the stock market. They pitch them as these fixed income alternatives that offer insulation from market panics.
That's the sales pitch, yeah.
Here's where it gets really interesting to me, though. If I'm an investor nearing retirement and I want pure stability, wouldn't a non-exchange traded REIT be the absolute smartest play? Like it doesn't bounce up and down with the daily chaos of the stock market ticker.
That pitch is honestly one of the most effective psychological illusions in all of finance.
Wait, illusion.
Yes. The perceived insulation from daily market fluctuations isn't because the underlying real estate is somehow inherently more stable. It is simply a byproduct of the lack of a secondary market.
Oh, wow.
You aren't seeing a daily price update because the shares aren't actively trading. A skyscraper owned by a public REIT and a skyscraper owned by a non-exchange traded REIT are subject to the exact same macroeconomic forces.
Out of sight, out of mind.
Yeah.
You just don't see the red arrows on your brokerage app, so you feel perfectly safe.
Exactly. And the trade-off for that psychological comfort is severe illiquidity.
Meaning you can't get your cash out.
Right. If you suffer a personal financial emergency and you need your principal back immediately, you cannot just hit a button and liquidate your position at market price like a normal stock.
That sounds terrifying.
It can be. You are often locked into very long holding periods, or you're subject to extremely punitive redemption fees, assuming the sponsor even allows early withdrawal at all. So you essentially sacrifice the ultimate safety valve, which is liquidity, in exchange for simply not having to look at price volatility.
That is a massive distinction to keep in mind. Just to round out the structures, the sources briefly mention an alternative for the investor who maybe hates the idea of pooled funds entirely.
Ah, yes, the tick.
Right, it's called a tenant in common or TIC arrangement. It functions similarly in that investors pool capital for large commercial assets, but a TIC is capped at exactly 35 investors and they target one specific property.
And the ownership structure is different.
Yeah, you actually receive a separate deed and title insurance for your fractional portion. You get the full legal rights of a direct owner. But obviously, you are putting all your chips on one specific building, completely destroying the diversification benefit we talked about earlier.
Yeah, the tick structure really appeals to investors who are executing 1031 tax exchanges, but the concentration risk is exponentially higher than a diversified REIT.
Okay, so assuming you decide on a standard publicly traded equity REIT, your next hurdle is figuring out if the company is actually profitable. And this is where traditional finance knowledge actually becomes a bit of a liability.
Very much so.
Because if you try to read a REIT's balance sheet using standard corporate accounting, you're going to completely misinterpret everything.
Yeah, if you evaluate a REIT using standard GAAP, generally accepted accounting principles, the company will almost always look like it is just hemorrhaging money.
Which is wild. Why?
The core issue is the GAAP mandate regarding depreciation.
Right, because under standard accounting, GAAP forces companies to assume their physical assets degrade and lose value over time, eventually hitting zero on the balance sheet.
Which makes sense for most businesses.
Exactly. If I buy a fleet of delivery trucks for my logistics company, GAAP depreciation makes perfect sense. A truck genuinely loses value every single mile it drives. But a commercial skyscraper is not a delivery truck. Real estate generally retains its value, and in most thriving markets, it actively appreciates.
Right, but because a REIT's entire asset base consists of real estate, these mandatory gap depreciation charges artificially slaughter their reported net income.
So they look broke when they aren't.
Exactly. A highly lucrative cash-flowing property portfolio might look completely unprofitable on paper simply because GAAP requires them to deduct massive depreciation expenses every single quarter.
That's crazy.
So to solve this, the industry universally adopted a specialized metric called funds from operations, or FFO.
Okay, tell me how FO actually fixes the math here.
So the National Association of Real Estate Investment Trusts standardized this FFO calculation. You start with the official GAAP net income.
The flawed one.
Right. Then you exclude any runtime gains or losses from the strategic sales of property because those distort the view of everyday operations.
Makes sense.
Finally, you take all those artificial depreciation and amortization charges and you just add them back into the total. The resulting FFO number provides a much, much more accurate reflection of the true operating cash flow being generated by the rents.
So FFO strips out the noise of selling buildings and neutralizes the fake depreciation penalty.
Exactly.
Now, while we are on the topic of operational quirks, there is this fascinating loophole mentioned in the sources regarding taxable REIT subsidiaries, or TRSs.
Oh, this is a clever one.
It really is.
Yeah.
Because of those strict 75 and 95% income tests we discussed earlier, a REIT is legally restricted from providing active services to its tenants. So if a REIT owns like a luxury apartment building and wants to offer a premium housekeeping or a concierge service, they literally can't do it directly without jeopardizing their passive tax status.
Right, because that's active income. So to solve that, the REIT spins up a TRS. This subsidiary operates as a standard taxable corporation.
A complete separate entity.
Yep. It provides the active services, pays regular corporate income tax on its profits, and then kicks dividends back up to the parent REIT. And those dividends neatly fall into the allowable bucket for the 95% financial income test, keeping the entire ecosystem fully compliant.
It is such a clever workaround. But I want to go back to FFO for a second because I'm looking at this formula and I have a major issue with it.
Okay, let's hear.
If FFO just blindly adds back all depreciation, it basically relies on the assumption that a building stays perfectly pristine forever.
I see where you're going.
Right. But buildings do degrade. HVAC systems die. Roofs literally cave in. Lobbies need million-dollar modernizations just to compete with the shiny new building across the street. If FFO ignores all of that, aren't we willfully ignoring the very real, massive capital cost of keeping a skyscraper functional?
Your skepticism is entirely justified, and it actually highlights the primary danger for amateur investors in this space. Relying purely on the headline, FFO number is a trap.
A trap.
Yes. FFO is a standardized baseline, but as you pointed out, it completely ignores recurring capital expenditures, the maintenance, leasing commissions, tenant improvements. To find the real truth, an investor cannot rely on those glossy top-line metrics.
So what do?
You have to dig into the supplemental disclosures in the quarterly reports and manually subtract those capital expenditures to arrive at what the industry calls adjusted funds from operations, or AFFO.
Oh, wow. So the true cost of doing business is literally buried in the footnotes.
It always is.
Which brings us perfectly to the ultimate investor's dilemma. We've navigated the history, the 90% rule, the flavors, and the accounting illusions. Now we really need to connect all of this directly to your personal portfolio strategy.
The practical application.
Exactly. How do you actually choose one of these trusts, and what is the massive tax catch waiting for you in April? Because avoiding corporate tax means fatter dividends, but we all know the IRS always gets their cut eventually.
They do. And the tax treatment of REIT dividends is arguably the most crucial consideration for your after-tax yield. Because the REIT itself acts as a pass-through and pays no corporate tax, the dividends they distribute to you are generally not eligible for the favorable 15 or 20% qualified dividend tax rates that apply to standard corporate stocks.
So you get hit with the ordinary income tax rate.
Yes, which means, depending on your tax bracket, you could be paying up to 35% or more on those distributions.
It's a huge bite.
It is. It fundamentally changes the math of your net return, which is exactly why these assets are frequently held in tax-advantaged accounts like IRAs, where that tax friction is entirely eliminated or deferred.
But there is a silver lining for taxable accounts, right? The sources talk about this concept of the non-taxable return of capital.
Oh, yes. The mechanics of this are quite elegant, actually, because a REIT's cash flow often exceeds its taxable income again, Thanks to that gap depreciation we talked about, a portion of your dividend might be classified not as standard income, but as a return of your original investment capital.
Okay, so what does that mean for taxes?
It means you do not pay tax on that portion in the year you receive it. Instead, it lowers your cost basis in the stock. The tax is entirely deferred until you eventually sell your shares, at which point it is taxed at the much lower capital gains rate.
It's an incredible deferral mechanism. Though I will say, the sources warn it is notoriously difficult to predict exactly what ratio of ordinary income versus return of capital a REIT is going to declare at the end of the year.
That's true, it fluctuates.
So, assuming you are completely comfortable with the tax profile, how do you actually pick a winner? The source material leans really heavily into macro-level demographics, because you aren't just buying a building, right? You are buying the economic momentum of a region.
Exactly. Population migration, employment growth, corporate relocations. If a REIT is heavily concentrated in a region that is actively hemorrhaging jobs, the underlying asset quality won't save them.
Right, because nobody's renting it.
Macroeconomics dictate the rent levels and the occupancy rates. But you also must scrutinize their historical dividend behavior. If a REIT boasts an exceptionally high yield, you have to find out how they are actually funding it.
Wait, what do you mean?
Well, are the dividends supported by stable, recurring rental income, or is management just selling off their best properties to artificially maintain a high payout and keep investors happy?
Oh, wow. If they're selling the actual buildings to pay the dividend, they're basically eating their own seed corn. The yield looks great today, but the future cash flow is being completely hollowed out.
Precisely. And that behavior is usually driven by the incentive structures behind the scenes. You really must read the prospectus and determine exactly how the external management team is being compensated.
I'll put this directly to you, the listener. Are you looking for current income right now to fund your lifestyle, or are you looking for long-term appreciation over 20 years? Because the way the management team gets paid tells you exactly whose goals align with yours.
Exactly. If the management's fee is calculated based on assets under management, the total value of the portfolio, they are heavily incentivized to just endlessly acquire new properties.
Empire building.
Right. They want to build an empire, focusing on capital appreciation, sometimes even diluting existing shareholders to do it. Conversely, if their compensation is tied directly to current earnings or dividend performance, they will obsess over maximizing the yield, potentially neglecting long-term asset improvements. The incentive entirely dictates the strategy.
Always follow the money.
Oh,
All right, let's pull all these threads together. We started with the 30-year freeze that ended when Eisenhower finally democratized the sector in 1960. We broke down the pass-through entity cage, specifically that 90% distribution rule that forces these trusts to constantly hit the equity markets for fresh capital.
yep.
We explored how mortgage REITs act as banks that are highly exposed to interest rates, while equity REITs act as the landlords. We threw GAAP completely out the window, learned why FOF is the starting point, and why the real truth is hidden in the capital expenditure footnotes.
AFFO.
Exactly. And finally, we weighed the heavy ordinary income tax burden against the benefits of return of capital.
It is a deeply complex ecosystem, but honestly, mastering it offers a remarkable tool for portfolio construction. Because commercial leases frequently contain escalators that are tied to the consumer price index, REITs inherently act as an inflation hedge.
Oh, that makes sense.
Yeah, as the cost of living rises, so do the rents, and consequently, your dividends rise too. They provide a dynamic yield that fixed-rate bonds simply cannot match in an inflationary environment.
Provided you are actually willing to read the fine print, they really are the ultimate shortcut to owning the Skyline.
They really are. However, relying on the historical resilience of real estate requires a final, critical piece of forward thinking for anyone listening. We noted that macro demographics, employment trends, and population shifts are the ultimate drivers of occupancy.
Right.
If you are analyzing an equity REIT today, particularly one with a portfolio heavily concentrated in massive urban commercial office buildings, you have to factor in structural paradigm shifts. How will the permanent integration of remote work, flexible corporate footprints, and changing commuter demographics fundamentally alter the appreciation curve of those specific brick-and-mortar assets over the next decade? The historical math may simply not apply to the new reality.
Wow, the ultimate wildcard in the AFFO calculation. So the next time you find yourself walking past a towering downtown skyscraper, you don't just have to daydream about collecting the rent. You know exactly how the plumbing works to actually do it. Just make sure you check the footnotes first. Thanks for joining us on this deep dive, and keep questioning the numbers.